Hey, this is Justin with daytradethemarkets.com, and I wanted to talk about 4 different trailing stop techniques that you can use to ideally hold winners longer. And the reason that's relevant today is because this was another day where, at least in the index markets, we were rallying to new all-time highs. So being able to hold a trade a little bit longer than maybe it's comfortable is certainly a strategy that can pay off on a day like today. So let's make an assumption here, and this is a trade we talked about in our live session today about getting long in this area right here. And I won't go into a great amount of depth on this, but if you want to look at the video that I posted yesterday, I talk about the 2 out of 3 method. And essentially what we're looking for here, the reason we talked about this being a pretty good place to get long in our live session today was that if we start with the idea of what's the big picture bias, it's up. We know that going into the day, and certainly it's nothing but confirmation that the big picture bias is moving higher, or that the market's moving higher. That's nothing but confirming that the big picture bias being up makes sense. So all things equal, if our big picture bias is up, we'd rather be long. And then we have this zone, this area here, and that I've done in magenta. We know this going into the day. You can see that right when we opened, we came right to the resistance side of this zone, sold off a little bit, but this selling box that came in, we couldn't get any follow through. Okay, and eventually we banged our head on this a little bit here, but eventually we were able to break above this zone. And when we can break above a zone like this, that's also a bullish indication, okay? And if we can get above a zone like we were clearly able to do here, then we would expect on a retest of that zone that it should give us some support, okay? That's the idea there. So we've got a zone situation telling us that we'd rather be long. We've got our big picture situation telling us we'd rather be long. And then we have the location within this zone, knowing that's the support side of the zone. That should be a good spot. We're also above this selling box that has just failed. You know, I'll make this a little bit darker. I can make that darker here. So we're above that. We know that when we're above that, it should offer us some support, which is what it did. And we also know that toward the low of a buying box, and I'll make that a little bit thicker in here as well. This is all stuff we talk about every day and teach. We know that this is bottom line, we know this is a really good spot. Big picture says we'd like to be long. The zone says we'd like to be long. The box level evidence says we'd like to be long. It's telling us this is a pretty good place to be long. And the location is good because we know that we're wrong if the market starts to get comfortable back inside of this zone and if it can trade below this green box, okay? So basically our risk, if we're getting in somewhere in here, our risk is about like that, okay? That's about that much. Okay, so if we're, in other words, if we're getting long about right there, our stop should be about right here. You could get away with less than that. I'm just saying this is kind of the ideal, hey, we're definitely wrong, it's not working type of an idea, okay? So there are a few different ways that we can talk about in terms of trailing stops when we get into a trade that works. Not every trade, of course, is going to work. We have to be able to deal with that emotionally. You know, there's no such thing as 95% winners. It doesn't work that way. You're simply trying to get into positions that make more sense, that you have an edge, that makes sense to when you put the evidence together, that makes sense that you have an edge. Okay, that's what we're trying to do. There's no secret holy grail 90% method out there. It just doesn't exist. So I always like to say that because it filters away people that still believe that. It just doesn't work that way. So what we're trying to do is get ourselves into good positions. This makes a lot of sense for getting long somewhere in this area. Our risk is pretty reasonable relative to the chance of this working out. Now, we don't know that this thing's going to go higher like it does at that time. Certainly in hindsight, we know that, but at the time, we don't know that when we get into a trade. So we've got a few options for getting in them. And let me list them. So here they are. The first one is just having a predefined target. In this case, if we're long from right here, the next decision point that we would need to think about would be the high of this box, the high of this green box that came in. So somewhere in here, or because the prior all-time high is right here, it could be somewhere in here, okay? So there is no shame in just putting a predefined limit order to sell right near the high of that box, okay? If this is our risk, you know, here's our reward. It's about 1 to 1. And it's a very high percentage that it's going to work. In other words, if you could flip a coin and it's heads or tails, it's 50%. But you know that you know. In other words, let me put it different. If you could flip a coin and you make $1 if you win, you lose $1 if you lose. But you know that the percentage of it winning is somewhere between 65 and 75%. That's a pretty good coin flip to make. So there's no shame in, you know, having a 1-to-1 risk to reward ratio when it makes sense. Okay, so that's the first idea, is just having a predefined target, and that's totally fine. And that's how some people like to trade. There are other people, obviously, that want to try to hold on to winners a little bit longer. And I don't think and I think that's ultimately the best way to trade if you can have the stomach for that. And especially if you can define situations where the market's pretty favorable. Again, this trade looks pretty bullish as we're heading into it and we're approaching all-time highs. So we know that if we can get above there, it should be pretty smooth sailing. We'll have to see. Okay, so that's the first one, is a predefined target. The second one is rejection at a decision point. Okay, it's kind of an offshoot of the predefined target where, hey, we're looking for the market to make a decision when we get to the high of this box, okay? And today what happened is we broke above there very briefly, but very quickly came right back in there for a moment, okay? So and we talked about this in the live session, if you are a little bit risk averse and you want to just get out and lock in a profit, there's nothing wrong with getting out right there. When we test above at this decision point, and our first piece of evidence is that quickly it came right back in. Now, in this case, it ended up going higher, but it very easily, that could have been the end of the road. We see this concept called a box rejection a lot, and there's no shame in just getting out right there. Again, pretty good trade. You gave it a chance to have a breakout if it really went on the first try, but the first try it didn't. It came back in. You get out right there. Nothing wrong with taking that approach, okay? But you're not just doing it based on gut. You're not just doing it based on fear of giving back your profit. You're doing it based on true evidence. You're saying, I know that the market needs to make a decision at the high of this box, or we would expect the market to make a decision at the high of this box, and at least the first time, it looks like it's popping above and quickly coming back in. It looks like we're in trouble. There's no shame in taking profit right there. Now, of course, this was a day that broke out, so it doesn't look like that's the best decision. Most days aren't huge trend days, and so taking this approach and getting out at the decision point right in here is not a bad idea. There's nothing wrong with that approach. Now, if you like to hold a trade a little bit longer, and every trader has to decide this for themselves in terms of what their style is. And again, I think the ideal scenario is trying to identify the context of the market to determine when does it make more sense to maybe take a quick profit versus when does it make more sense to let the market develop a little bit longer. Today would have been a case where perhaps it makes sense to let it develop a little bit longer. So the next technique we want to talk about is what we call the aggression bar trail. And that's if we get one of these level 2 or level 3. Here's a level 3, the dark blue. That's extreme buying aggression. Here's another one. Here's strong buying aggression. Here's another strong one, the green there. Those big aggression bars, those are a good place when we see one of those to trail our stop behind that. Okay, so in the NASDAQ, I would typically recommend 4 or 5 ticks below one of these big aggression bars. So as soon as that aggression bar comes in, you just trail your stop to there. The next time we get a big one, it's this bar right there. So we can trail it up right in there. The next time we get a powerful one, it's right there. So this one almost takes us out, but we can, if we use about a 4-tick trail, we can put our trail right there. We hang on. The next one's over here. We can put it there. Next one's over here. We can put it about right there. The next one, this is a selling box. We can put our trail about right there. Now, in this case, it would have been a little bit of bad luck in the sense that it would have just nicked us right there and stopped us out. But that's a pretty good trade. Again, if this is our we're just letting the market develop and using actual evidence, not our gut, not fear, okay? But if this is our risk, this is our reward on a trade like that, somewhere in this neighborhood right here. That's, what is that, 4 or 5 times? Not a bad way to trail. Now, this is an outlier trade. They don't all run like this, but that's a pretty good way of using some structure to trail, okay? Now, a fourth way, and I don't necessarily recommend this too often, if you can really identify, however, that the market's in a really strong trend where we're stacking buying boxes like we have today, then you can do a situation where you actually wait for a box to fail. So in other words, if we get in here, then we're holding. When this box comes in, our stop's going to be below that box, okay? And then when this next box comes in, our stop's going to be below that box. When this one comes in, our stop's going to be below that box, okay? Now, you're going to give up, eventually a box is going to fail, and you're going to give up a decent chunk of your profit to do that. But so I would only recommend using this if you're the type of trader that really likes to hold on for as long as you can, trying to hold on all day, and you can identify a situation, which today would have been one, where we're in a clear trend. When boxes are just stacking, that's not a terrible approach, okay? It's not typically one I use, but it's one that you can use some pretty good logic. You can use logic to make pretty good sense of that. So I hope that makes sense. I know I threw a lot at you in this video. Hopefully it did kind of, again, makes sense. But I just want to talk about different ways. Every trader is a little bit different, and every trade is a little bit different. So we always have to put the market in context and then put ourselves in the context of that trade as well. Do we like to hold? There are some people that holding for more than 5 minutes would just be torture. There are some people that can't imagine, getting into a trade and taking a 1-to-1 profit. They want to go for 4 and 5 and 6-to-1. Different strokes for different folks, right? But there are different structures that you can use to apply that can help you make the best decision that you can make based on your personality and based on the context of the market. Hopefully that makes sense. If you have any questions, let me know. We'll talk soon. Thanks.